Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
Good morning, everyone. Welcome back to another Wealth Coffee Chat. I'm Daniel McPherson from Positive Tax Solutions. It's Tax Tuesday, and today we'll be diving into something that I guess becoming more and more common and gained a bit of popularity with everyone over the last few years, and that's becoming a backyard developer. But before we dive into that, just a reminder that the Property Summit is on the Gold Coast from the 13th to 15th of June. So anyone that's interested in elevating your understanding of the property market and some strategies for lifelong wealth through investment, there's going to be some acclaimed guest speakers, our 6-star team, and some great opportunities to network with the experts and like-minded people. So reserve your ticket. We'll drop that into the chat, and looking forward to seeing you all there.
All right, this is going to be fun. Who has played the property game before? Who has been in the game? Who's never played the property game before? Oh, you're in for a treat. Who likes Monopoly? Did anyone like Monopoly when they were a kid? Well, this is Monopoly in real life in this room. Every hour or so, you guys are going to be up and you're going to be running around the room like maniacs trying to play the property game and win the property game.
Today, I wanted to share the lessons, the mistakes, and the wins.
I want everybody to put up their hands who knows their interest rates on all their loans right now.
If you haven't seen me around before, like 13 years in the industry, in property management specifically.
Who likes paying tax? If you need help finding somewhere to donate, I'm sure I can find somewhere else where it can go.
No, we've got an expression in that, let's go and make new mistakes in the world. Who wants to make new mistakes?
These are just strategic moves that can make such a big difference.
So obviously buy well, never sell. Definitely the majority of what everyone's looking to do is collect some A-grade assets, B-grade assets, whatever it might be.
I loved the idea of being a property investor and developing that identity.
Collectively, they have way more years experience in everything that you think you're trying to solve. Because they do it every single day.
Awesome. Only a couple of weeks away now, so hopefully we'll see a heap of you there. All right, so maybe you've heard someone say, we've got all this land, what if we split it or build out the back? or maybe we're thinking of knocking down the old house and building a couple of townhouses instead. So this is what we call the classic, I guess, backyard development, or I guess classically known as the mum and dad development. And it's really often viewed as a simple, low risk, high reward strategy. And don't get me wrong, done well, it can absolutely be a really powerful way to unlock wealth from your property that you already own. But, and there's a big but, there are some traps, some pretty serious traps, and there's tax traps, lending traps, legal issues, and the biggest of all is the assumptions that people make. People kind of assume that they're sort of just modifying their family home, but legally, financially, you're crossing into a commercial sort of developer territory. So today we're going to cover, I guess, what a backyard developer or development actually is, why it looks so attractive, some common traps, particularly with the finance, GST, and capital gains tax, the hidden risk with the main residence exemption, and I guess a few things to think about before you start. So let's jump in. A backyard developer is typically someone who already owns a block, usually their own home, and wants to unlock value by developing it. So that might be either subdividing and selling off a portion of the backyard, building a second dwelling to rent or sell out the back, or knocking the whole thing down and building 2 or more new homes on that land. So we know you're not a commercial builder, you're not a Mirvac or a Stocklands. You're just someone with a bit of equity and big enough to consider, I guess, doing something smarter with it. And I guess that's the danger. It feels personal, but the ATO, your bank, and your council definitely won't treat it that way. And I guess here's a couple of reasons why I guess people consider it. You already own the land, so there's no stamp duty. You have loads of equity in there at the time. You might be nearing retirement and wanting to downsize, help maybe your kids into the property ladder. That's a good way of doing it. Or simply sick of having underutilized land and want to do something a bit more productive with it. So we've seen backyard developments make hundreds of thousands of dollars for everyday people, really. But you need to treat it like a mini business project. The costs and the risks are real, and we see people jump in without really understanding what they're triggering and making some rather large and expensive mistakes. So let's talk money first, because this is where often things fall apart. We call, I guess, people running into a no man's land. One of the most common mistakes we see is someone demolishing the existing dwelling or house, only to realise that they can't get finance to build the new ones. And here's why, is because when you've got a house on it, the bank saw it as a residential property with value. Maybe you even had rental income that can help with your borrowing capacity. But once you knock it down, all you've got is dirt and the land value. And most banks won't lend you much just on vacant land. And then even worse, I guess, if you're working with a broker early, you might now be unserviceable. So this puts you in no man's land. You've lost income, you've reduced security, and now you're stuck. So I guess the key tip here is to make sure you get your finance approved before your demolition happens. Have a build contract and use a broker that understands the residential to construction transition. If you wait until after demo, it might be too late, and then you can really get into a bit of a pickle. Okay, so let's talk about one of the most misunderstood areas in small-scale development, which is GST, and also then the difference between capital gains tax and ordinary income. So when you develop a property or sell part of it, even if it's just your backyard, the ATO wants to know, as they do almost everything these days, they want to know, was it a one-off transaction, capital transaction, or are you carrying on a business or an enterprise? And that distinction matters a lot. So when you sell an asset you've owned for a while, like the family home or a long-held investment property, so the ATO usually treats that as a gain, so a capital gain. So this means as an individual, you may qualify for the 50% discount if you've held it for over 12 months. You might get the main residence exemption if it was your home and you were living there. And the gain is only taxed when the asset is sold. But it's different if you develop with the intention to make a profit. And this is even if you just intend to do it once. You can cross across into the realm of ordinary income, and that means that the full profit is taxable. There's no 50% discount on it. So the ATO sees you as operating a business or an enterprise. And once you're into this territory, then GST can also apply. So in other words, you're really just not passively selling land, but actively doing work to improve and sell it, such as subdividing, building, marketing it, and very likely it's going to be income, not capital. So this is can be a bit of a grey area, so it's best to seek advice. But let's just say you bought a home 10 years ago, it's been your main residence, you decide to subdivide the backyard, build a couple of townhouses and sell them for a profit. Now, if you sell the land without doing much to it, might treat it as capital, and you only pay the capital gains tax on that. If you build and sell, the ATO pretty much will almost certainly view that as a profit-making enterprise. So that means you're taxed on the full income, no discount, and there's GST. So when it comes to GST, there is something called the margin scheme. So I guess if you just sort of note that, and remember to always ask about it, but it's a method of reducing the GST sale on a new property. So whenever we sell new residential, there is actually GST that applies in the sale, can actually apply in the sale price. So normally a sale price, just say it was 1.1 million, so 1/11 of that would be GST, so 100,000. But with the margin scheme, instead of paying 1/11 of the full sale price to the ATO, you only pay 1/11 of the margin. So I'll give you a quick example. So if we've got a property that you sell for 1.1 million, you originally bought the land for 550,000, so your margin is 550,000. So the GST under the margin scheme would be 50,000 rather than the 100,000 that you would have to pay if it didn't apply. So that's a 50K difference, and that might be per property. So it will add up pretty quickly into your margin if it's not factored in. I've seen too many people get this wrong and lose basically their whole upside from it. But the most important thing is to be aware of it and to get advice even before you begin. And then I guess that rolls over to the next trap that we see is the main residence exemption, which most of the time is kind of like the gold for most homeowners. People assume that I've lived here for 20 years, so when I sell it, it's tax-free, but not necessarily. Once you subdivide, develop, or demolish, the exemption can disappear in its entirety pretty quickly. So I guess trap number one is subdividing your block. So let's say you subdivide your backyard and sell the rear block. It might be like a battle axe or something like that. Or you might have a corner block. Even though it's been used as part of your home, it's now a separate title, and the ATO view that as creating a new capital gains tax asset, and it's no longer covered by the exemption. So yes, the part you live on might still be tax-free, but that rear lot out the back is now taxable. And I guess even worse, sometimes if you're carrying out any development such as laying pipes or preparing it for sale, it might be considered as ordinary income and not capital, meaning no 50% discount either. So that's something just to keep in mind. And trap number two is demoing the house. So if you demolish the house, you've destroyed the CTG asset that had the exemption. Now, if you build two new dwellings on it, these are two completely new CGT assets. So you still might be able to claim the exemption on one if you intend to live in it and finish the construction within 4 years, and obviously don't have another main residence during that time. But if you sell both, the entire exemption's gone. And the third trap is building, renting, and selling. So some, I guess, people will think that they'll just build a duplex, rent them out for a while, then sell them. And I guess the issue is the second you decide the purpose is income or sale, then the ATO sees this as enterprise. So there's another trap that you can kind of walk into without realizing it. And again, just to remind you, if it's treated as a profit-making intention, you lose any main residence exemption and the CGT discount. So you get the whole whack at your marginal rate. So I guess the key takeaway, even if you've lived in a home for 20 years, if you want to build, flip it, or subdivide it, you're potentially losing the exemption. So always key to get tax advice before signing a contract or listing the property for sale. You might be able to structure it a bit more smartly, potentially using structures, or maybe live in one long enough to qualify for an exemption, but definitely need to have a plan beforehand. A few other considerations, I guess, before you decide going full backyard builder. So council approvals, will they even let you subdivide the property? The costs, so you really need to do your feasibility study on what you're actually going to make out of doing it. So these are like site costs, infrastructure contributions, utilities, permits. Need to factor in the time as well. Is there going to be builder delays? How long does the DA take to get approved? What's my cost to hold and not earn any income off it? And then also cash flow. So what happens if it takes longer than expected? How are you going to fund it? And then also, as we said before, structures. So do you develop in your personal name, a company, or a trust? So I guess getting this wrong really affects everything. So it affects tax, asset protection, finance, and then your legacy planning as well. So you really need to get this right. So I guess, is it worth it in the end? It can be. It can be a really powerful way to unlock equity within your property and really create long-term wealth, but only if it's done right. So before you call a builder or grab your shovel, make sure you talk to your accountant, talk to your broker, talk to your legal planning team. Make sure you get the advice. It's not just a casual renovation, it's a real project, and the consequences are real as well. So treat it seriously, get the advice, and hopefully it can be a big step forward in your wealth journey. Perfect. Well, that's it today for me for another Wealth Coffee Chat. If you've got someone who's building on their backyard, make sure you send them this episode right away. It might save them hundreds of thousands of dollars. But until next time, take care and keep building wealth wisely. Thank you.
Thanks for watching another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.au.